Joining me now is Koby Kushner. He is the CEO of Libra Energy Materials. Great to see you, Koby. For those who don't know, you were an analyst at Red Cloud for quite a while, and now you're off on your own with your team running Libra.
Yeah, that's right. Look, it's great to be on this side of things, and now I'm the one getting interviewed.
Exactly. So let's get into it, and we'll start with lithium itself. We interviewed Rick Rule a while ago, and he said his favorite sector at the time, this is maybe a month or two ago, was lithium because it's so hated. So he loves that contrarian play, and you're sort of doing a bit of a contrarian play as well in going public this year, the only lithium player in Canada to do so. And so why go public now? What was the strategy? What's the thinking?
Yeah, I mean, we certainly didn't need to go public, right? We were private during the downturn, which allowed us to preserve our cap table, and we never had to do any of those overly dilutive financings. But what I saw as a private company was a commodity that was hated, per what you say, per what Rick Rule says. And the equities are down 80-90% off their peaks, and a lot of these companies some of them had great assets that they never even really explored, and they started dropping their claims, or it goes back to the prospector. Prospector has a hard time getting rid of these claims, or they pivoted off to gold. They don't care about their lithium assets anymore. They chase the next hot thing wherever they can raise money. And I see an opportunity at the bottom of the market to consolidate the sector, and it's way easier to do that in a public entity for several reasons. One is that just making a splash as a public company is shown to be a magnet for M&A opportunities for us. And the other is that you're now able to use your paper as currency. It's hard for people to care about private paper. People are always asking, like, okay, well, what's your real valuation? And now we're letting the market decide what we're priced at.
It reminds me in a way of, and you don't need to answer this, you can if you want, but what Jordan Trimble did at Sky Harbor with uranium, not lithium, but uranium, years ago, buying up claims, pennies on the dollar, basically. Yeah,
like as well, Consolidated Uranium, which is now part of ISO Energy, like that one went pretty well. And they were buying assets for nothing, and give it a couple of years' time, and they look incredibly smart for doing what they did. So,
Koby, you said you stayed private deliberately for a while. So can you expand some more and flesh it out more in terms of what the benefits were of that? And also, you have this unique clause in there, basically. It's the founder's lockup. How would you describe that?
Sure, yeah. Well, the benefits to being private is that it allows you to be extra, extra lean. And in our case, because we were private and because it was lithium, we really didn't have a choice but to be incredibly lean. So we were able to preserve our cap table. What I mean by that is what you saw during the downturn, when companies ran out of money, they would do these very desperate financings loaded with warrants at low prices, and liquidity would dry up, so it was hard to get people out of the story. So when they'd get out, their stock price would just fall off a cliff. And because we were private, we didn't have to deal with those issues. We didn't have to, it's been over a year since we last raised money, right? Like, we didn't have to do those desperate financings. As a result, us, like insiders of the company, we still own almost half the cap table. We managed to preserve a very, very tight structure, 57.5 million shares out currently. That's it, and never had to roll it back and start fresh. And then the founder's lockup, this is, in my view, it's the most restrictive lockup agreement I've ever seen. What I mean by that is that there's no cheap blocks, there's no blocks of cheap paper waiting to unload to the market. It's the guys behind the shell, David Goodman and his brother, our chairman, and a co-founder of the company, Mark Goodman, and myself. We're all subject to this lockup agreement where 26 million shares of the 57.5 million out, so roughly almost half the cap table. None of us can sell stock until there's an actual change of control transaction, or in certain other circumstances, but there's no timed release of paper. And what we're trying to tell people is that we are riding this out for terminal value.
That's great, because usually you have that 4-month lockup, and maybe it's longer, but and then if people want to blow out their shares, they can, especially maybe not management, but other investors and so on. So that's I think that's very unique what you're doing there. Now, in terms of the slide deck of Libra, I noticed that you claim that you've made more lithium discoveries than any other peer based on a per dollar raised basis, and you do have a differentiated approach compared to the traditional way of doing it. So how would you describe that, and why is it successful?
Well, yeah, let's touch on that. By my analysis, in the height of the lithium rush in 2022 and early 2023, let's call it, by my analysis in Canada at least, it takes an average of about $5 million in terms of capital raised needed to generate a new lithium showing in Canada. And I included assets that these companies acquired, often using paper in there. And that number, $5 million, excludes all the companies that raised a whack of money and don't have anything to show for it, which is frankly a lot of companies. So I'm being very biased against Libra here. In less than a year, after less than $2 million raised, we found lithium mineralization on 3 separate projects. Our approach, to your point, it's been a bit different. We have to keep in mind that at the height of the lithium rush, people were chasing marketability over prospectivity. So what I mean by that is they would stake ground adjacent to, Patriot Battery Metals or PMET now, and wherever they can try and raise money on the back of, even if you're in the wrong rocks. So I say this a lot, closology is a really poor indicator of prospectivity. What matters isn't what's on your neighbor's ground, it's what's on your ground. The other thing is we have to consider that most lithium mines today, most lithium deposits actually being drilled off today were actually found totally by accident, usually years ago, while searching for something else. I mentioned Patriot, so Patriot, that was not a new discovery. Don't get me wrong, they were the first to drill it off, but that was a gold project in the early 2000s. Lithium mineralization was noted on surface by Virginia Gold Mines, and it was logged, and they didn't care. They continued on with the search for gold. So we have to consider, look, if most of the stuff was found totally by accident, what's out there now if you search with purpose? And that's what we did. We just thought, okay, let's ignore closology completely. Let's ignore all the accidents and think more regionally. Where should this stuff occur? We've barely been exploring for it, right? We've been searching for gold, copper for millennia, and we've been searching for lithium for a decade, maybe. So let's consider there's got to be way more low-hanging fruit out there. And we thought more regionally, where should the stuff occur, stake it, and systematically explore it. And that's been our winning strategy. It's not that complex.
Yeah, it almost makes too much sense. But it's been successful, so that's great. Now, also successful on the financial side was an arrangement raising $33 million with Cobalt Metals. This is the company backed by Bill Gates, Jeff Bezos, and others. So can you elaborate on that and the significance of that transaction?
Sure. I mean, that's a $33 million earn-in. That's not a small number. And right now we have 7 projects in the portfolio, and probably by the time this interview is published, I imagine we'll have 37 after our Brazil acquisition. Right. And 3 of those projects are underneath this earn-in agreement. So in order for them to earn that 75% stake, they have to spend $33 million in the ground across cumulatively all 3 projects. So something that makes us unique is during this RTO process, we've been able to be cash neutral because we are actively involved during the exploration seasons. We're very active. We're in the field with them. And they've retained us as an exploration contractor. So what's unique about us is that we're now a revenue generating company on the back of that. Mm-hmm. So for us, it means it means a few things. We're able to generate news flow on someone else's dime. We're able to manage dilution, as I just alluded to. That exploration expense covers our typical burn rate, right? And as well, we're with a very capable and competent partner, and ultimately the reason we went with them is because we thought that it would increase our odds of making more additional discoveries.
Now, you touched on Brazil, and you said you were looking for M&A. You struck this deal, I guess, last week, 10 days ago or so. So why Brazil, and why that deal specifically? And then can investors expect more M&A as we go through the year and into 26?
I'd say yes, they can expect more
Yeah.
M&A. I mean,
Okay.
I can only say so much on that.
Yeah.
But that is the second type of that is the second M&A transaction that we've done since we went public in mid-July. The first one being at the asset level. There's kind of three levels of M&A for us. There's the project level, so that's for example, our Waguchi project. We staked that a little bit before we our go public. That's a project we had our eyes on for a while. It was staked up, and you don't spend money on it, you lose your claims. And that's what happened. Those claims were dropped, we immediately staked it. So that's the cheapest kind of M&A, you stake it yourself. The other kind is buying it from a third-party vendor. So our Stimson project, we paid, this is there was a historic drill hole. It hit multiple intervals of the host rock that contains lithium mineralization. So multiple intervals of pegmatite with possible spodumene noted within the core. So that was already optioned off to someone else at the height of the lithium rush, right? They lost their option agreement. Prospectors, are having a hard time giving away good assets. So we were able to get that for 50 grand worth of stock. That's it. 50 grand worth of stock to get this asset. And it's not, I'm not to... there is a marketable aspect too, being next to a 130 million market cap company, which is Power Metals. Obviously, we got it for its own reasons. The fact that it happens to be next to this is something else. And it's already drill permitted. So again, 50 grand worth of stock to get 100% outright. The Brazil acquisition, I love Brazil. If you remember when I was here after my site visit, I was very bullish on Brazil, very bullish on a company, Latin Resources, which was my top pick, and then it was taken out last year. But what I love about Brazil is the timelines to production. So in addition to its geologic potential, which is evident, you have very quick timelines to actually put a mine into production. Canada's amazing, but Sigma went from maiden resource to production in under 5 years despite COVID. Again, I love Canada, but you just can't do that here. That's not going to happen.
Yeah. It's interesting. Yeah.
That acquisition, that's 4 million shares, and almost half of which are going to be entering our founders lockup agreement.
Great.
So excited for that deal to close. We love the assets. We more than doubled our footprint with less than 10% dilution. So just keep that in mind.
Yeah.
Hopefully that really emphasizes why now is the time to be consolidating quality lithium assets at the bottom of the market.
I remember we talked to the head of Latin Resources a few times, and Sigma Lithium. We interviewed him in New York a few years ago, and so those were success stories. And so just in terms of lithium, just to wrap it up here, to my amateur eye, it seems like the stocks seem to have bottomed, and they're starting to move like an Albemarle way up the food chain in terms of market cap. So can you summarize your thoughts in terms of the sector and the investment case for Libra? Because investors, as you know, are always looking for different ideas. Maybe they're focused on gold and silver right now, but you want to say, hey, look at us, we're doing okay over here.
Yeah, well, let me kind of pitch you on three things, and it'll hopefully tie everything together here. So the first thing is that the bottom market consolidation strategy makes a lot of sense. Personally, I'm very bullish on lithium. I personally hope it doesn't move up too quick again, because it'll just attract more dumb capital into the space, but which is bad for everyone, right? But also, we're in M&A mode. We want things to stay low a little longer, because that makes our acquisitions much, much, much cheaper. That being said, lithium is such a small market, and it only takes a couple operations coming online or offline to be the difference between a surplus or a deficit. And the most bearish banks out there, the most bearish analysts out there still think that the deficit's returning in the coming years. By the end of the decade, which, we're nearing the end of 2025 now, it's not that far away. And then the most bullish analysts out there think it's coming back in 2026, which is a very tight window. And historically, lithium has always usually been a shock on the demand side. And I'm incredibly bullish. I think that this year, most cars being sold in China are now electric. So electric cars have taken over, and a lot of developing countries, places like India, they've actually where not many consumers have cars yet. Instead of starting off with combustion engines, they're actually going straight to electric now, because Chinese EVs are actually cheaper than combustion engines now. So they're bypassing combustion altogether and going straight to electric in developing countries. So we live in the Western world. Western media and often drives the narrative, but what matters is where's demand globally, not where is it here. So the fact that equities are trading incredibly low and no one wants lithium right now, and we can get it for so cheap with very little dilution, makes a lot of sense. And I bet you that we're going to look smart in the next couple of years by doing exactly that strategy. So that's point one. Consolidation in lithium makes a lot of sense right now. We've seen it happen in the majors with Rio Tinto. We saw it happen with Piedmont and Sayona, Pilbara and Latin. We have not seen it happen amongst the juniors. So that's what we're trying to be at the forefront of. And second part is I think we're the right team for the job. Myself being a former lithium analyst, and before that, at heart, I'm a mining engineer. I've seen mines fail, I've seen mines succeed, and in this type of strategy where you're casting a wide net and you're trying to figure out, do a little bit of work, you have to be able to systematically screen things quickly. Is it going to be a mine or not very early on? And what I love about lithium is that you can better determine that earlier on in the exploration cycle compared to things like gold and copper. It's exploration for lithium is a lot easier and a lot cheaper. Our team also, it's a very technically savvy team. Our geologists both have master's degrees in geology. One of them wrote one of their theses in S-type pegmatites, which is very relevant to what we're doing. And we also have an advisor who wrote his PhD in lithium pegmatite exploration. And hopefully we've now established the track record. Per dollar raised into the company, we've come out with more lithium discoveries than most of our peers, at least to my knowledge, all of our peers. And it's not just me saying our assets are good. We've won a Discovery of the Year award for one of our discoveries. We've attracted a $33 million earn-in with Cobalt Metals. We've caused a staking rush near one of our projects with some other bigger players. So again, it's not just me saying that our assets are good. There's enough third-party validation that hopefully it limits the amount of due diligence actually required for retail investors to know if our assets meet a certain quality. And the third thing I want to kind of pitch you on here is that it's the right vehicle to pursue this strategy. So the strategy makes sense, the team makes sense, but it's also the right structure. The way that our cap table is built, it's with long-term investors. This isn't a stock scheme. This isn't a giant promo machine. As I said, I think in the next 2 years, we're going to look really smart for what it is for the strategy that we're pursuing now. And our cap table very much aligns with the strategy in terms of the investors that are in there right now. They're long-term investors. And it's also half the cap table is forced to be long-term investors. So that's how we think. And those three things right now: strategy, team, structure, and I guess to add to the team, projects and our capability of making discoveries would be number 4.
All right, great stuff. Very informative. From analyst to CEO, looks like you're born for this role. So we'll see you again.
Thank you so much.
Okay, good stuff. Koby Kushner, CEO at Libra Energy Materials.